Okay. I got 2 o'clock. We'll give it here another few minutes before we get started. So hope everyone's staying warm. I know I am. I'm still stuck in Brazil, so I can't make it home.
Probably about 100 degrees difference here.
Yeah, I'm pretty sure it is. Yeah, we have days where gets up to 90. So if it gets 10 below there, yeah, it's 100-degree difference. So I think we could probably get started here. So hi everyone, I'm Matthew Cruz, president of Commstock Investments. I have Justin McKinney with me here. So he's going to be presenting a brief commodity outlook for 2023, and we saved the best for last. So we've been doing this for a couple months or more now, and if you have any questions as we go through, feel free to type those in. There's a Q&A box at the bottom of your screen. You can type those in. Go ahead and do that, because I know sometimes they take a little bit to think of those and get those typed up. So and this will be recorded as well, and we'll have it sent out to you. So I guess without further ado, I'll hand it over to Justin.
Well, thank you, Matthew. Just wanted to welcome everybody also to our last webinar, the 31st January, and we'll get started here. And my slide won't advance. There we go. Just to start this out, we are a commodity brokerage firm. Our disclaimer: futures trading involves risk. I'll give you a few minutes here to read that all the way through. If you have any questions on that, we would gladly address those also.
Yeah.
All right. So Commstock Investments, some of you, I'm not exactly sure who was on the webinar. It's kind of weird doing this, not knowing who you're talking to, but just run through, since I'm relatively new with Commstock, some of the people that I know that may be on the webinar may not know what we offer completely. So we'll just run through this quick. We are a commodity brokerage firm, full service commodity brokerage. We do cash consulting and some seasonal spec trades. We'll get into the seasonal spec trades a little bit more later on, but that's the meat and potatoes of our business. With that, we have the Commstock Daily Report, comes out twice a day. David writes some great articles in the beginning. We have some broker comments. Also, our spec trades are listed in there. We have our new app. Love the app. Getting quite a bit of positive feedback back from our app off of the cell phones. You can download, listen to the report while you're driving to the feedlot or the hog barn, or just going down the road. We offer crop insurance. That's a long-standing business of Commstock. But the new to this year, we have a licensed agent offering LRP, livestock revenue products. If you have any interest in those, we'll also talk a little bit about that later on. Feel free to reach out and we can get you in touch with the proper people on that. Definitely a new twist to the marketing side of things on the livestock. Interested to see how that pans out and the positives and negatives of that. But like I said, we'll talk about that a little bit. The property and casualty insurance has been a staple of Commstock as well. And our Brazilian farmland tours, Matthew just recently wrapped that up, I believe, last week. And sounds like they had pretty good weather, saw some fairly decent crops. Any questions on that, you can direct those to us and we can get you in touch with Matthew. Excuse me. So just a little bit about myself. Picture my wife, our dogs outside our house. I grew up on a small dairy farm in Southwest Wisconsin. Did not want to be in the dairy industry, went to school. After school, got into commodities, spent the last 18, 19 years, somewhere in there, in the cash merchandising business, all the way from New Orleans on the southbound freight desk for a while, a little stint in Anawan, Illinois at the ethanol plant buying for them, And then the last 11 years I've spent in Southeast Minnesota working for a large co-op, and they also have a river terminal. So the majority of my background, as well as being a broker for the last 4 years, but has been in the cash side of the business. It's just where I started and kind of eventually evolved into working for Commstock full time. All right, so our next slide is from the January WASD report. We're not going to spend a ton of time on these numbers, kind of old hat. There's a couple things that I like to take home about this slide, and one is the export numbers that we'll talk about and later on. It pegs us at a carryout of a 1.242 billion bushels, a very tight stocks to use number. Doesn't allow for a lot of hiccups, and maybe doesn't allow for a ton of exports this year versus last year. We'll get into that in the next few slides, but the other take-home point on this slide is the projection for the 23-24 crop. Rough numbers, 92 million acres, a 180 national yield, which to me feels like that's subject to debate. Either way, we talk about La Nina, switching to El Nino, and things like that. That's probably the biggest thing that I look at that number at the bottom, that 2-1 carryout. Seems like a relatively big number. And it is if it comes to, but it seems awful early to be throwing out that 180 yield, in my opinion. So we'll move on. If there's any questions on this, we can come back to that later too. But like I said, these numbers have been out for quite a while. So this slide I just put up there to demonstrate the weekly gasoline demand and where we're at versus last year. We're slightly behind. We need to keep the ethanol grind high to hit targets for the USDA ethanol numbers. I think that's definitely a possibility. We're pretty early in the year, quite a bit of the driving season to come up. Just a general reference of where we're at and where we need to be. You can look all the way to the right hand of the slide. The majority of that very well could have been the December snowstorms or travel plans, or not plans, but conditions over the holiday season. We kind of saw a slump there, but it looks nothing out of the ordinary. It looks to me like we should be pretty much right on track on that. These numbers came out last week. They're the weekly ethanol numbers. Again, as we look at those S&D numbers and projections by the USDA, it's going to be very crucial to keep that ethanol number where it's at. Production was up last week, not significantly some, but it was up a little bit. Stocks were up quite a bit. So as we build these stocks coming into driving season, hopefully the economy doesn't fall off too hard, where we see a robust driving season this summer. Another slide, just a very quick one to briefly touch on. The red line above is where the weekly production needs to be. The green is where it's at. We're really not that far away from that. I wholeheartedly believe that we will be at that line moving forward. So I told my wife I'd put this picture in. It's a picture of her and I and the elephant, but it's not really a picture of us. She gets kind of upset when I say that, but exports, moving to exports, the elephant in the room. Everybody has heard how poor exports are. I think that may be of getting too much publicity and pressure in the markets. When I started this presentation, putting the slides together, I thought for sure we would see export numbers, that would be the shining star that, hey, we're not going to rally this market based on these export numbers. And the farther I got down the road into the slideshow and the presentation, the more it got me thinking. So we'll run through the export numbers and the ethanol number, or the export numbers, and some thoughts at the end. But just to take home, corn sales last week ended at 35 0.8 million bushels. The week before at 55, so dropped off significantly. And I really think the balance of the year BOI at 29 versus last year at 21.5. It doesn't feel like we're going to even be close to that with South America crop coming online. Matthew has talked about the harvest down there. If the weather shapes up, we're hearing more reports on the wires of possibly better corn, second crop corn, or more acres down there. China, there's been so absent in the market this year, 4 million metric ton this year versus 12 and change last year. It surely doesn't feel like China is going to show up to the marketplace this year with the safrinha crop coming, cheaper corn in Ukraine if they can get it out. It just does not feel like we're going to meet that export number. How much of that number is left to be determined, but we'll see in the weeks coming. Now, this is a corn basis chart. I know some of the other brokers have put this up there, and I'm not putting this one up there because I'm assuming that everybody can call their local merchant and get their bids or go online and find this. The reason I'm putting this up there is relationship to the export market. If we look at the areas that are very strong, we know the Nebraska, the Kansas, possibly into Western Iowa, some basis is relatively firm compared to historicals. So, and we look at those export numbers being poor, you can see in the mid-miss, the upper miss, the northern grain belt, that's where the surplus of corn is. And somehow we have to figure out how to get that corn to Nebraska, Kansas, places like that. And this slide will be kind of important as we move ahead and think about where basis is going to move. As I left the grain merchandising world and moved into the brokering world, I thought we were done talking about basis on crops. It seems like we talk about basis just as much now as I did then, except we don't buy basis. So moving forward, just kind of remember where that surplus is. And we're going to talk about delivery value. What is your corn worth? Nobody on this webinar most likely is actually going to deliver on a futures contract. David wrote an excellent article last fall for our daily newsletter about the tail wagging the dog and how basis was disconnected from the Board of Trade. And while that's very much true in 2022, we look at that and we had multiple factors leading that. And some of those factors may not be quite as relevant this year as they were in 2022. So just for reference point, I know that if I need to get corn, I can take delivery in Peoria and get corn at 8 3/4 over the board. So if we go back to our basis chart and look at those areas around where we can actually originate cash corn, that's our hard number plus freight to get it to wherever we need to get it to. Okay, so what happens? We talked about the basis, we talked about delivery. How does that affect the market if exports do show up? We'll definitely see the front month squeeze as the exporters can take delivery of futures and put it on barge and get it down the river versus places in the West that probably are going to need to put that on trains. So we'll see that front month squeeze the back month, narrowing the carries. 2022, we had huge inverses, March, May, and so on. Basis firmed on the mid and the upper last year versus this year, we're very slow to react. It's starting to switch some, which makes me a little less bearish the basis, but it has narrowed some. And in my opinion, I'm selling the rumor, buying the fact on any export sales announced on corn and beans. I just don't necessarily believe that they're going to be loaded out of the center Gulf or off of the PNW. We'll need to keep watching those liftings reports. The corn was pretty poor this week. So we'll have to keep an eye on that moving forward to see if those sales get rolled or canceled or moved to South America. And this is just a quick slide on why those inverses hurt commercials and how that affects cash grain farmers. Most of you on this webinar are not a commercial grain merchandiser or own commercial grain, but it does have a direct correlation to how it affects you guys. So we just use the example. This is taken March, May, trading at a 3-cent inverse. And David has done an excellent job of outlining this in the Commstock daily reports. Cost of carry, we know, is increased exponentially over the last year with interest rates going higher. But if we look at a commercial grain elevator, taking a 3-cent inverse plus interest, you're looking at a 9-cent devaluation in their company-owned merchandise. Now, it could be up to 12 cents if they hold to May. June would be more. March, July is trading at 17-cent inverse. So the take-home point here is these commercials will be hitting these better basis bids, keeping a lid on those spreads unless we see an increase, a huge increase in export demand. Elevators will always ship as hard as they can to avoid those negative mark-to-markets. And it's not always possible to do that from a commercial standpoint. Logistics is getting to be a huge portion of that with truck freight, getting drivers, hours. Many of these are co-ops that have agronomy seasons that overlap with drivers. It's getting very tough. So when these basis numbers get good or better, I would expect against at least the March, we see a pretty good amount of commercial grain move. Okay, so back to being a farmer and how that affects me. If we can just think about this for a second, we have margin calls, whether we have a futures position or not. Is inventory is gaining in value every day or going down in value every day? You also, if you are holding unpriced grain in your bin, are subject to any inverse and betting on either a rally in the board or a rally in the basis to offset that carrying cost. And we've talked a lot about that in our daily reports. I know not everybody's a subscriber to our daily reports, but the take home point on this here is to manage your inventory and keep an eye on getting the grain moved into the market before we get that flush at the end of the summer, weather pending. If we carry, I've always used the phrase carrying grain to August is either a zero or a hero. And in 2022, you were definitely a hero. We had excellent export demand. We had excellent ethanol demand and a short crop in South America. Possession was 100% of the law, especially west of 35. Some of the guys in Western Iowa and Nebraska saw phenomenal basis numbers that maybe quite won't get there this year. In 2023, if we do see a kick up in that ethanol usage chart that we had up there, we very well could see the market chew into those bushels and cut into that carryout. So as we talk about basis and inverse, we move ahead to the commitment of the traders, who actually owns it. As of Friday or last Tuesday, report released on Friday, producers and merchants were short about 396,000 contracts of corn. Those are contracts not broken out specifically by month, but I would guess a pretty fair percentage of those will need to get rolled or priced against the March and the May. So that's something to keep an eye on moving in the next 2 to 3 months. Managed money, just over 200,000 contracts. Seems like they're in the middle of the stream, not exactly for sure which way they want to row on that. As we move into crop insurance pricing and spring weather, I would kind of suspect the one direction to get picked either way as far as the managed money goes. Whoops, sorry about that. Soybeans ended up, the producers and merchants were short about 180,000. Sounds like there's quite a fair amount of beans in the northern part of the belt that's looking for a home. basis has really widened out up there in the last 2 weeks. So that export demand has not lifted off of the PNW rail line yet. It may come. It'll be interesting to see if that does show up later on in the year. So our strategies for old crop corn, and I can't drive this home enough, and this is something that's been increasingly relevant in my 18, 19 years of doing this. Just straight offers, having them working. If I had $1 for every time I get a phone call that said, oh, I missed it, or I was going to sell at this level and now it's not there. Huge returns are for 2022 crop. Offers work. They'll get filled 20 or whenever the market's open. Sit down and put some hard numbers to where we're comfortable making sales at. I put the next one bullet point on there. In 2023, short futures very well could outperform just straight hedge to arrives or cash contracts, especially west of the Mississippi River. And the reason I make that point is they're very often processors, end users will not allow you to roll a hedge to arrive. They won't allow you to, if there ends up being carried, they will force you into pricing in that delivery window that you've already picked. Where a short futures position allows you to have the leverage depending on where your location is. I think there's a play there for sure. Especially, like I said, west of the Mississippi and west of 35, where the corn is a little bit tighter. I like the option spreads, relatively reasonable cost if a guy wants to stay long corn in the bin, protect us against any black swans. You very well could add that to a basis contract. There again, you're giving up ownership and negotiation ability on that grain. So maybe not quite as much, but it definitely does work. I had a call from a guy whose basis shot up to 70 over. Like, well, yes, in that situation, and he doesn't want to price it because he's friendly to the board. In that situation, I would probably take advantage of the basis and then look at a put call window or straight put or something like that. We do have a ton of time for planning production problems, any sort of managed money flow to come back in. If the Western belt stays dry, weather pattern shifts. So I can't disagree with this logic there. I do like those option spreads at a relatively affordable rate. And there are some short dated ones. When I put this together, 680 was at the money maize that expired at the end of March for 20 cents. It gets us through that crop insurance pricing. I understand the crop insurance pricing is for the new crop corn, but it also will get us through almost to acreage intention, planting intention time. Might not be a bad trade there to protect some inventory in the bin. So this slide is 100% for David Cruz, as we talked about our strategies for new crop corn. And his strategy was build a bin, which is great. I wish I had a bin, I'm working on it, but use crop insurance floors, protect indemnity payments if we do see those spike ups this summer on production issues out west. My concern with insurance has always been, in my farm, my APH is 200 bushels. If I do a really great job and get 225 or 230 bushels, crop insurance gets to count those bushels next fall against me, and therefore I'm actually lowering my insurance guarantee. Anything above your APH, if we see a rally in the market, I'm probably looking to buy some puts on. And if you must make fall sales like myself, I realize I'm giving up the basis potential for basis gain and carry in the market. There's no real good way around that. We can buy calls or straight futures or things, other products, but you are leaving the basis gain on the table. And just, I've been saying this for over a month. For me, and I know the Chicago Board of Trade doesn't care what my cost of production is, but I'm not willing to sell my corn for under my cost of production 11 months out. There's too many unknowns. I don't necessarily buy that 180 yield, what we posted earlier, or the 92 million acres. I'm going to look at doing some crop insurance and probably puts or put call windows on my corn. And moving into the soybean numbers here. Again, this is the WASDE report. Not going to spend a ton of time on this. All this is pretty much known. The carryout at 210 million bushels is a very tight carryout. We should see prices at pretty decent levels. And one could argue at a 1541 March board, we might already be there with the production coming online from Brazil is. So shrinking carryout, whether we actually load those sales and use those beans here is to be determined. But looking at the numbers for next year, for me, the take home on that is a 52 bushel yield, which I probably buy that 52 bushel yield more so than the corn yield. A carry out at 370, it's awful early, in my opinion, to project that, but I don't necessarily have a problem with that starting number. I think with crop insurance guarantees getting ready to start pricing tomorrow and being under last year's guarantee, it may be a little bit more of a struggle to get bean acres than what was anticipated, say two months ago or 2 weeks to a month ago. As we move forward and we talk about exports are a completely different storyline on this. Sales last week at 42.1 million bushels. Last week at 36.2 million bushels. And this week last year was 37.7. So the balance of the year comes in at 9.1 million bushels versus 17.8. I struggle with the 9.1 as our carry out at 210. I don't know that we have the beans readily available to move to the market. And with South America, 5% estimated harvest moving forward, I can't imagine where we wouldn't be switching some more sales down there. China has been a huge buyer of beans, 28.2 million metric ton versus last year, 25.4. The unshipped sales, just about 2 million bushels higher this year. I would completely believe that the bulk of those possibly could get canceled or rolled. So therefore, watch the liftings report every week as well to see what is actually getting loaded out of the Gulf and the PNW. And I put this chart up here, as we can see with those strong exports, that Illinois waterway delivery system has been running a fairly tight basis. And the excess beans, again, the northern part of the Mississippi River and northern Minnesota and North Dakota, places like that. So we don't have that export. We have that export draw, but it has been filled out of the Illinois waterway delivery system. If we continue to sell beans, I would anticipate those will have to get lifted somewhere off of the northern part of the belt. Just from past experience, I'm guessing that most of those beans have been shipped down there. The invoices have been very large in soybeans. Interest costs really rack up on a commercial setting. So as we move forward, I would anticipate the basis may be improving if those exports come through on the upper part of the Corn Belt. Moving over to the crush margins, huge. There's well documented $2.50, $3 bushel crush margins. Continue to expect money to flow into that. The increase in soil demand, again, soy oil demand, in my opinion, definitely has some work to do to originate acres. Looking at that, when I put the slideshow together on Friday, looking at that NOV-DEES, Spread at 2.29, fertilizer trending lower. Not everybody's fertilizer is trending lower, but the national average is cheaper. And guys like to plant corn. So I'm maybe a little bit more friendly to that than per se the corn. The renewable diesel demand not going anywhere. It doesn't feel like it's going anywhere. It has the backing of green. It is viewed as a more green fuel than ethanol. Ethanol feels like it's kind of run its course, at least for the meantime. And the renewable diesel is getting much more well received on the West Coast. Also, a point that sometimes gets brought up is that Malaysian palm oil, the export policy has been all over the board. In fact, today they just announced Malaysian palm oil futures were down hard as they have changed some of their exporting policies this morning. So I don't see that demand going anywhere anytime soon. Back to our points for soybean marketing. This is kind of, I'm sure some people are scratching their head. You know, I just said carry out is very tight, and then I'm saying sell the rallies on old crop. Again, we're approaching contract resistance highs in the March contract. It feels like a large portion of this may be priced in already, depending on what the Argentina crop does. But we won't know that right now. And with the liftings, if we start to see some cancellation, that market's probably going to move relatively quickly. So those areas western Iowa, northern Minnesota, those crush plants still need to originate beans. There's way too much money on the table to close the doors. They will have to come get the beans, but I imagine they're probably waiting for those to come to the market. So moving to livestock, hogs and cattle, two very different markets. Cattle have the bullish fundamentals, and hogs are just, well, hogs controlled by the integrators. It seems like the cutouts have been just falling out of bed on hogs. The load count, we've been selling a lot of pork, but they can't seem to catch a bid in the futures market. So moving on to the cattle, the numbers are very encouraging. And there's also been some reports of pork fatigue in the retail sector. So our cattle on feed slide just shows as a percentage of last year, all states trending lower. The semi-annual cattle on feed report is out this afternoon. Don't anticipate any bearish surprises in that. And I really like this slide for the cattle feeders, and I bring this one back to myself as we do feed some cattle. But the green dot is the current, the blue line is last year, and the 5-year average. So we are looking at cattle supplies that are above the 5-year average. And the bullishness is definitely in the fourth quarter. I look out at the futures market and I see huge premiums out there that could be taken advantage of. The bullishness is a long ways away, it feels like, but possibly priced in the market already. So just some tips on the marketing of the cattle. Continue to hear from cattle feeders and producers. The cattle crusher remains very profitable on cattle that they're placing on the lot today, if it's locked in. 2024 futures look fantastic. I'm not sure if we bumped up to the 170s yet, but definitely top end of the 160s. How much of that's priced in with the economic news coming out daily, large corporations announcing layoffs, and talking to some people that I never thought that these companies would go through massive layoffs that are. It makes me a little bit concerned about how much of this premium is already priced in. And you can go back to the cold storage report last week. There wasn't a lot of great news in the cold storage report, and those cuts were put in the freezer at relatively expensive values. So to move those and to continue to move beef into the market may be a little bit of a challenge. But I just threw up some option windows to manage the downside risk. relatively reasonable. I don't know that anybody wants to take a 154 of June today, but it does leave you some top side at, you know, a fraction, $1.20 or so cost. And you can see those out through the August and the October. Obviously the time value costs a little bit more, but it does leave you some top side with bottom side protection. Straight board hedges. And if a guy really is concerned about the top side on those, we could add a call and make a minimum price contract, something like that. New to Commstock this year is our LRP insurance. Both of that on feeder cattle and fed cattle is an excellent option for producers that do not want a board position. We can write you a policy that's head specific based on price and many other factors. I am not a licensed agent, so I can direct you to the proper channels for that. Eric can answer those questions. I do know that the premium is due at policy expiration. Kind of helps cash flow a little bit. Some people like that. You are locked into it, but beyond that, I'll leave that to our licensed agent to answer those questions. And I think the number one thing that everybody's concerned about, and what we talked earlier, is the economic fears, the consumer demand. If those budgets continue to get tightened coming into the spring, summer timeframe, black swans, anytime I've owned cattle, it just seems like black swans follow that market around, just waiting to pounce. And also the packers margins are getting squeezed. Believe me when I say it, so sorry for them. I'm not, when they made $500 to $1,000. But will they slow down chain speed to try to clean those coolers out of that high dollar inventory? The push for cattle may get moved back to second, third, and fourth quarter where the numbers are very tight. So as we wrap up my slideshow here today, just conclusions that I thought of. When I started this out, as I said earlier, I was convinced that it was bearish corn, bullish beans. And as I went through and did my slides, I kind of reevaluated that. Staying flexible is very important, especially for those people west of 35. I think there's going to be opportunity there that maybe Southeast Minnesota doesn't participate in as much. Watch those export liftings. And if we see those spreads, bull spreads, the March gaining on the May or the May on the July, basis breaks in the export market, either in the river or the rail, I would venture to guess that the river would probably break much quicker than the rail due to the pull of grain west. As we mentioned earlier, our spec trades, most of those trades are 80% winners or better. They're through the More Trading Research. We publish those on the Commstock report when we find ones that we like. So far this year, they've been fairly successful. If anybody would like more information on those, they can surely reach out and touch base with us. Crop insurance or the LRP questions. I know I personally ask Eric questions all the time as I'm looking at how to manage the risk on these grass calves I'm going to buy that are going to cost a small fortune. So that may be a very good option for some producers. And that's it, Matthew.
Well, good. I have a couple questions here. First one, with everyone, including the US, trying to increase crush capacity, wouldn't it make sense that those beans purchased would see follow through and buyers would take delivery?
Export or domestic?
I think, yeah, I think
on the domestic side, absolutely. I would anticipate them to buy and take delivery.
Yeah, I think they're talking about export.
The export side, I struggle with that as we have such a huge crop coming from South America, not necessarily Argentina. That's been well documented. Importing beans from Brazil and other countries to fill that crush capacity, but the domestics, I would say definitely, and the export market, I think those orders are going to get filled, but I'm just not sure that they're going to get filled from the United States.
We're starting to see chatter about the acre wars for next year between corn and beans. Do you have any thoughts or comments on that? What do you think we'll see going forward?
You know, there was a lot of problems west of the Mississippi in corn on corn this year. Corn on beans was phenomenal. It sounds good. It's, you know, everybody talks about, well, I'm going to do a 60-40 instead of a 70-30 rotation or a 50-50. When the rubber meets the road, it seems like guys want to plant corn. And I think beans have work to do to get those acres away from corn. Whether that's corn holding steady and beans rallying, or, you know, corn and beans both going up, that works both ways. Especially in where I farm, where tar spot is becoming an issue on corn. That can be anywhere from a 0 to an 80 bushel yield hit, depending on what time it hits. So everybody talks about planting more beans, but I know myself, I'm planting more corn this year.
Yeah. What someone asked about what black swans that we can look out for, or we think might happen, but people ask that question, and if we knew the answer to that, then it wouldn't be a black swan. Black swans are the things that happen that nobody can imagine happening, I suppose. So
I would say the number one for me is the economy. You know, when I look at consumer spending, and, you know, to move the market, the majority has to be wrong, right? We have a lot of bets in the cattle pit that the market is moving higher. And so something to prove the market wrong, however small or insignificant it may be, could be a significant move, in my opinion.
Yeah. You know, it was a black swan to a certain extent when Russia invaded Ukraine. And I think now we're looking at a long drawn out protracted war. And so I suppose it could be a black swan if Russia suddenly said, hey, okay, we're done, we're leaving. I think that would really tank the markets quite a bit, because it's you know, because it's restricted their exports out of the Ukraine quite a bit. So
and you wonder on that situation, Matthew, how much of a beating Putin is willing to take. You know, that could be a real possibility that we just back out and call it good.
Yeah, apparently quite a bit. So
apparently quite a bit so far.
But yeah, you had some numbers on, you know, you're going way out there, 23, 24, which seems like a really long ways out. You know, and it showed a higher ending stocks, I think probably mostly off of increased yield for that year. You know, it's sometimes you get too far out there, the numbers are less precise, I suppose. But I don't know if you have any further comments on that. You know, that because at least in the case of the soybeans, we're hearing all this chatter about a lot of these renewable diesel plants coming online, and so I guess the hope, at least for me, is that some of those the domestic consumption would increase from those renewable diesel plants to help offset some of the export market that we've been losing. So I don't know.
So I guess I probably maybe didn't present that in the way that I could have. In my opinion, those are worst case numbers, highest carry out numbers. 180 national corn yield, you know, 52 in the beans is probably somewhere in the ballpark. But I would agree with you 100% on that, Matthew. That is the first shot across the bow, and I have a hard time buying anything larger than that.
Yeah. because correct me if I'm wrong, it seems like there's this mentality out there that when you have good times like what we've had, there's a swift fall, and it's followed by a long period of lean years. And so I feel like that's what a lot of people are waiting for to happen. Like it's going to happen, and so everyone's pretty negative, let's sell the rallies. And I don't know if you agree with that. And maybe that's right, but there's still I think some reasons that we can look at. Well, why that isn't necessarily a foregone conclusion too, but I don't know if maybe that's just my experience. What do you think?
Well, and that's interesting you point that out, because so often as a grain merchandiser, we had people come in and sell corn 10 months out or 12 months out. And the classic line is, if this is your worst sale, how happy are you going to be? Okay. And probably 8 out of 10 of those turned out to be their best sale. Now, the years where it's droughted out, or you personally have a poor crop, those are definitely not your best sales. And as a merchandiser, it's conditioned to be bearish. So I don't want it to seem that I'm too bearish. I think there's downside risk in the market, but I also agree that there is upside potential out there, given those high carryout numbers already in the market for 23 crop.
All right. Someone asked about a book for dummies so they can learn more about the market. So maybe I'll let you follow up with that person.
Yeah, there is a book out there, and you put me on the spot, and I'll think of it as soon as this webinar is over. But if they shoot me a phone call or something, The Merchant's Edge. Okay. If I was going to read a book about cash grain, The Merchant's Edge is the one I would look.
The Merchant's Edge. All right.
Yes.
Yeah, that was a tough one right off the spot. So good. I guess last question. Here basis in spring, summer 2022. You see that strengthening in corn and beans, staying the same?
I do see it strengthening west of 35. Those producers in Northeast Iowa, it just doesn't feel to me that West pole has the strength that it had last year, that it's going to have to fight those export bushels. Almost every year we get some sort of planting basis rally. So I do think I would anticipate that. I don't think it's to the extent of 2022.
Okay.
East of 35, west of 35, where it's significantly tighter, you could see a pretty good pulley out there.
Okay. All right. Well, I think that's all the questions we have. So this is recorded. We'll send this out to everyone, and want to thank Justin and thank everyone for tuning in.
Thank you.
Yep. Have a good day. Bye.